Hi everyone, good morning to our weekly Monday webinar. Okay, this is Siong here, the US equities analyst. Today I'll just quickly go through what's the theme for the week as well as the company that we'll be featuring today. Alright, so this is the big picture, the equity markets. So as you can see, okay, what we want to tell you is that the world economy, the world indexes have actually outperformed the emerging markets. Okay, if you look at the first chart above, okay, what this means is that if you are not diversified, you're actually leaving a lot of money on the table, and this is something that you should look out for, especially for the US. US is very important in the equity market in terms of the total market capitalization. We're looking at $57.7 trillion. Okay, in this chart, you can see that the 2-year dollars returns, most of the leaders over here is actually the developed markets. You have US, Japan, Germany, okay, mostly, so in short, we are looking mostly in the EU as well as US. So the reasons is either because of structural changes, okay, let's say for example, Japan or the EU, they announce reforms, or the US where the economy is actually doing better than the rest of the world. On the other hand, emerging markets, if we actually, other than India and China, the rest of it mostly is because of the commodities. They have actually done very poorly, and so as a result, the stock market hasn't been doing that well either. So reforms plus relatively strong economies naturally gives you strong equity markets, and these are very simple themes that has worked superbly in the past. So going forward, how to play the teams? Okay, I'll just quickly go through what's a rating for the different economies. So for overweights, we have US, Japan, China, India, and Indonesia. Whereas we have a neutral rating on Europe, Singapore, and underweight on Malaysia. And these are the unit trusts and ETFs that can gain exposure. Okay, for the strong markets, that of course we talked about US, Europe, and Japan, which is done well historically. Okay, US is a relatively strong economy. Europe is recovery in the credit and central banking. Japan, regime change. China, even though we'll be about hitting the 7% target, but 7% is still a very high figure to begin with. India, Modi election, and then he has promised quite a fair bit of changes, so it's yet to be seen. Singapore, we have mixed economics, fundamentals. Okay, Indonesia, regime change as well, economic reforms under Jokowi. Malaysia, although oil is going to impact a lot of it, especially Petronas is a big contributor to the Malaysia government budget. Some of the themes that we are looking ahead, we have consumer-driven economies, right? So, so right now what we see is that oil price, definitely as it drops, the discretionary income will increase, and this will allow consumers to spend more. But of course, oil price will drop has also led to quite a fair bit of job cuts. So I mean, we are still pondering on whether the net effect is going to be positive or negative. There's also the turn in the commodity cycle. So right now, most of commodities, including most of commodities, are actually in the backwardation, where it costs more spot price rather than the future price. So as a result, a lot of these producers, they actually, okay, a lot of these traders are holding back. They are not buying a lot of it. But when you look at the oil market, that's a different case because the spot price is lower. So people are actually buying spot today and storing it for future sale. So a turn in the commodity cycle will determine how these 4 countries, Australia, Brazil, Russia, Canada, perform. Of course, we have new regimes. Japan under Abiy, India is Modi, Thailand is the junta right now, and Indonesia is the Jokowi. Lastly, oil. So if you figure out what the Saudis are doing, whether they'll be still maintaining production or cutting it, then you have insights into how these economies perform. Investment idea of the week, we have buffer-like stocks. So we are looking at Siong and Angel Super. Siong is a supermarket operator. Angel Super is waste disposal. So these are underappreciated industries, but with good growth outlook, superior return on equity, free cash flow, and as well as most of the competition. Of course, we would like it cheaper, as all investors do, but even at today's price, we still think it's attractively valued. Okay, going to Siong Group. So the closing price as of last Friday was 74.5 cents, target price 88 cents. Just a quick, so what the dividend, okay, it gives a 4.4% dividend yield for $1.1 billion market cap. So it's accessible to most people. And even the PE ratio of 23.9 times is a 10% discount to regional peer average. So again, Siong is a supermarket operator. Why we like it? Firstly, it's a market share gainer in highly competitive industry. In the last few years, it's been gaining market share. Superior margins versus local peers, and it's also above the regional average compared to, say, NTUC and Dairy Farm. And also by 2017, we're looking at 13.4% more store space. So this will also drive your sales and profits. Siong runs a supermarket chain in Singapore. Okay, so it has 15% of modern grocery sales as of 2014, which is 3% higher than 2011. Largest players NTUC, Giant and Cold Storage, are both run by Dairy Farm. So what the growth that you observe is supported by a 22% increase in store space since IPO in 2011. Moving forward, it will open another 13% store space by 2017. Its revenue has grown by 7.9% compounded annually in the past 3 years. Going forward, we expect a slower 3.7% CAGR for the next 2 years because its new stores opened in 2012 will have reached their mature stage. Siong, why do we like it? Firstly, it has a better EBIT margins versus local peers, NTUC and Dairy Farm. Even if you look outside of Singapore in the ASEAN, its average margins is still way above. Also, this is also a story about how the gross margins will expand. Okay, so some people might say that the gross margins have really increased in the last few years. How will it still increase? We think yes. Why? Because the higher margin fresh food sales will increase to 45% by 2016. Okay, so this will help the gross margins to increase from 24.2% to 25%. At the same time, we also have a bulk purchase of inventory, which will lower your cost of goods sold, COGS. Because why? How does this happen? The thing is that NTUC, with the biggest market share of 56% that we see earlier, they are the ones that's getting most of the bulk purchases from the supplier. So what Sheng is doing now is that they're just going to the suppliers and saying that since you're already doing this for NTUC, why not give me the same, give me the bulk purchase as well? So both the higher margin sales of fresh food of about 33%, plus increase of bulk purchase inventory will help to drive your gross margins. We also expect operating expenses to rise in the next 2 years due to higher staff and rental costs due to new store openings. Nonetheless, we expect EBIT margin to expand due to better gross margins as we discussed just the slide before. Thus, we expect net profit to rise 7% CAGR over the next 2 years. Okay, yes, you do see a slight dip. Okay, you do see a very significant dip from 2010 to 2011, but that's because of the closure of 2 matured stores from circumstances out of their control. What happened is that one of them didn't manage to renew the lease, and the other one was the government wanted to take back the land. So it wasn't because of underperforming store closures, but rather because of store closures. And going forwards, they don't see any store closures that will be happening in the near future. Of course, we have key risks, key competition from NTUC and Dairy Farm. At the same time, store closures, if any more, could soften any revenue growth because we only projected 3.7% compounded for next 2 years. Of course, staff costs could also increase as well. So staff cost is the largest operating expense component at the moment, and increased labor costs will weigh heavily on margins. So just a quick update on the reports that we have the last 1 week. OSIM, we downgraded from buy to accumulate because the share price actually risen towards our analyst target price. Kim Heng, we downgraded from buy to accumulate, but for now we are going to suspend coverage because this is not the right time to be buying oil stocks. We also issued non-rated notes on the company visits to CSE Global, Jaffa, SD Engineering, Golden Agri, Venture Corp, and Thai Bev. We also have results notes. Our analysts attended the results briefing from MRR Holdings, Kim Heng, Cinemas Land, Obi Land, Raffles Medical, as well as financial sector. Outside of Singapore, we will give a note on the Indian budget. We also have technical analysis update on Go, as well as the US listed Iconics Brands Group. Okay, going forward, this is the earnings that we'll be seeing. King One, Stanford Tires, TTJ, Vibrant, Life Brands, Sunride, IPCO, and Vic Plus. Okay, then we're also looking at the Treasury budget on this Wednesday, as well as the job openings on Tuesday. Okay, things we look out for, earnings looks like it's slowing. And also, we have the Japanese GDP and PPI to keep an eye on. We'll also be having a Philip Regional Conference on Tuesday. Alright, so now is the time for the Q&A. Thanks. Hi, we have a question from our audience. So, the question on Siong is two parts. One is that since it's hit this record high since IPO, any catalyst that will help to achieve even higher share price. And secondly, the next level of growth will be at the expense of the incumbents, or is the local market still large enough to accommodate the Siong expansion? So for the first part, any catalyst that will help you to achieve record highs. So as we discussed just now, there will be an increase in store space, and also we are expecting an increase in gross margins because of the higher margin fresh food sales, as well as the bulk purchase of inventory that will lower COGS. Secondly, so historically, it's actually been increasing market share at the expense of giants. So I'll just quickly refer you to the slide before. Right, as you can see, NTUC and Cold Storage actually more or less maintain or increase our market share since 2010, but the giant has been consolidating. It's actually from 16% to 10%. This because giant, so Shop and Save rebranded itself as giant as well, and they've been closing quite a fair bit of store space. At the same time, Giant has been participating in the tenders for the supermarkets in the last 4 tenders. So this is where Siong is coming in. We also have another question on Siong's dividend yield. It's 4.4% based on the last closing price. Right. Another question. What is the difference between bulk purchase and as in purchase? So bulk purchase, you are purchasing in bulk, and then Siong will be coming into process and breaking down into smaller portions for resale in stores. For as is purchase, essentially just taking whatever the supplier gives you and then putting it onto the shelves. Hi, hold on. Hi, there's also another question about Keppel Land, whether to accept Keppel Corp's offer, and if Keppel cannot get 90% of Keppel Land, what will happen to the shares? Okay, so just a very quickly factual comment on it. If Keppel Corp gets less than 90% of the shares, then they'll pay 4.38 per Keppel Land share. If they get more than 90%, they'll be paying 4.6 per Keppel Land share. So, I mean, right now it's trading about 4.55, which means that the market thinks that there's a very high chance of it being able to cross 90%. But if it, in the case that it doesn't, maybe say 89.98%, for example, then they only be paying 4.38, and you might see Keppel Land shares drop slightly. Thanks.
Hi, there's a question with regarding to IP having a significant drop in the last few weeks. This is mainly attributed to the management's guidance that they are gonna guide for a first quarterly loss in the first quarter of this year. But however, we still continue to expect that they will, on a full year basis, they'll still be having better profits year on year due to the new contracts that HiT has secured, mainly from the Chinese mobile phones. So we do, overall, we do expect that there's still potential growth for HiT's stock.
We have another question, whether the opening of a big box store like Big Box will affect the sales. Right now, we don't think that is a threat, because Big Box doesn't enjoy the economies of scale that Siong and Giants, Cold Storage, and NTUC does at the moment. Okay, so Siong. Okay, then another part of it is that that the market can't be increasing all the time, taking market share through store openings will invite defensive moves. Okay, we think that that is a possible scenario, but at the same time, if you look at the NTUC net margins, today's NTUC net margin is only 3%. There's only so much that they can do without eating into their bottom line.
I have a question of whether Saudi preparation and lowering oil prices by the other OPEC members. Actually, Saudi itself is producing really around 50% of what OPEC is producing on a daily basis. So in fact, Saudi itself is like OPEC, and it's more like you'll be raising oil prices rather than lowering, right? So that's what we've been seeing over the course of last week.
Hi, this is Richard speaking. There's a question on 800 Super. The question is, the share price is dropping. Any reason for it? No, there's no news to that warrants the selling of the 800 Super shares. As for the recommendation, we are still maintaining our target price of 63.5 cents for 800 Super. If you look at the current price now, which is 44.5 cents, and the estimated core recurring EPS of 5.3 cents as forecasted for this year, it implies PE currently of 8.4 times. If you look at 2 weeks ago, actually 800 Super had announced contract win of about 38 million from the Ministry of Home Affairs, and that contract is supposed to last for 3 years, which if you average it out is about 13 million per year of extra revenue for 800 Super. And what you see is that 800 Super is actually gaining traction with even the ministry as well. What we like about 800 Super is that it's a resilient business and they have a strong free cash flow generating business.
We have another question. What is the advantage of Siong versus competitors, since it doesn't have pricing power over products and economies of scale? Okay, actually for Siong, right, Siong, Giant, and NTUC prices are pretty similar, but also lower than Cold Storage. Siong is also more vertically integrated down the value chain, so it does most of the processing by itself, whereas NTUC and Giant will outsource, say, the cutting to the party. So this ensures that Siong will get a better margin than the competitors. Just add on an observation about Siong. So Siong actually has the least number of outlets compared to the competitors, but the margins are also among the highest. Thank you.
Hi, Benjamin here. There's a question on if there's a rise in interest rates now more likely in June with the latest US employment report. So the US employment report is looking good, but our house call is still for a slow and gradual rise towards the end of the year rather than in June. Alright, so the next question is if this is favorable for the bank counters, which I assume you're referring to the Singapore ones, and is it bad for the economy generally? So for the banks, yes, increasing interest rates does benefit them, as a lot of their loan use, the trade loans as well as some of the corporate loans are priced off the short end interest rates of the USD LIBOR curve. Alright, so with the increase in the interest rates, definitely you see a repricing upwards for this sort of loans, and we should see the impact sometime in the second quarter of 2015 this year, right? Because the loans typically take about 3 to 5 months to reprice. Alright, Is this bad for the economy generally? Of course, we're referring to the U.S. economy itself. The fact that interest rates are going to be raised is a sign of good health for the economy. But for Singapore-wise, economy is still slowing down. All right. But the increase in interest rates might be a slightly negative for, let's say, the consumer segment as well as the SMEs. Right, but overall, as long as it's a slow and gradual increase, we shouldn't be too worried about seeing non-performing loans showing up. Right.
Hi, this is Sam, and there's a question on please comment on trend of USD going forward. We still believe that it's gonna strengthen further over this year, especially because of the difference in monetary policy in US is supposed to get tightened up by the increase of the short-term interest rate, while on the other hand, Eurozone, Japan, and most of the other countries are still very much into their loose monetary policy. That means it's a simple simple analysis shows that the USD will strengthen further, especially in starting from the third quarter of this year. Yeah.
Hi, we have a question again on Siong. Okay, again, the reader asked what is the catalyst going forward for Siong. Okay, so we just quickly summarize again. It's a market share gainer. It's historically gained market share from giants, and we don't see that changing. Plus, the store base will be increasing by 13.4% in 3 years' time. At the same time, we're looking at gross margins to expand because they're selling more higher margin fresh foods. And also, their bulk purchase or inventory will be going up. So this will cause your COGS to decrease. So this slide on margin expansion. Thank you. Okay, one last question for the day. The reader interestingly asked, is the Siong show effective for gaining customers? To be fair, it's pretty hard to quantify the effect and whether this marketing has helped to boost sales. All we know is that this is probably an indirect contribution to how sales and market share has increased over the years since 2010. Thank you. Okay, so with that, we'll come to the end of today's webinar. Thanks for joining us. Hope to see you again next week. Thanks.